to deal.
Hello and welcome to BloombergQuint. We are joined by Mr. Sanjiv Chadha of Bank of Baroda. He's just taken over as the MD and CEO, and the first quarter results was announced by him, where the bank reported about a 1,400 crore loss. Now, we understand that a lot of the loss is coming because of the divergence that was reported in FY19, and that sort of translated into the higher provisions. Trying to get a sense from you of what the banking system is doing. Because it's been about 4 years since the RBI has been conducting these asset quality reviews or the risk assessment reports, and banks still continue to report divergences. What is the reason why banks continue to do that? Is there a difference in understanding of how stressed assets should be classified between the RBI and between banks who are commercial entities?
So I think in any regulatory system, there will always be some element of difference in the understanding of the regulator and the regulated. But I agree with you, this has gone on for a long time now, and it is very important on the part of banks, not the regulator, on the part of banks to have a very clear appreciation of what the ground rules are and to adhere to those ground rules. So, but of course the quantum of divergences has come down over the last few years, and I do believe that the time is now near where banks need to focus upon making sure that they understand both the letter and the spirit of the regulatory guidelines. While you cannot eliminate divergences 100%, but to minimize is something which is certainly possible, and I do hope again that we are on the way towards that.
Right. As far as Bank of Baroda's quarterly results are concerned, now you showed about a 1% growth in your advances. Trying to get a sense of, you're now the third largest public sector bank in the system. You have a very high capital base, but still the bank chose to go slow on extending loans. Where did this growth stumble upon, and what do you see for the rest of the financial year, which is about another quarter left?
Right. So I think you're right. If you look at the aggregate numbers, the YoY growth is pretty much flat. But you need to possibly see it in the context of the fact that in so many ways the structure of the economy also has been changing, and banks need to realign their processes, systems, emphasis along with the new opportunities that might be coming their way. Within the loan growth, I think there's a fair degree of differentiation which is there. So you have, for instance, again, car loan growth, which in the case of Bank of Baroda has been as high as 43%. So if the bank has identified as a particular segment as a growth area, I think the engine in terms of underwriting is something which is working. Similarly, when we look at unsecured loans, which is again an opportunity in terms of improving margins, there the growth has been of the order of 29%, which also seems to be fairly good. When it comes to home loans, it has been 10%, which is lower than what it was in the previous year. But then we need to see it in the context of two things. One is we have seen some challenges in the home loan sector in terms of the propensity of buyers to buy flats, particularly which are those which are under construction. So there are challenges which are there in the sector. Along with that also, I think pool purchases came off during the last few quarters. If you look at the core retail driven home loan growth, that is lower but not much lower. Having said that, whatever are the mitigating circumstances, it certainly is not something which is sustainable that you have virtually no growth over a year. So I think the bank is now well positioned towards growing more aggressively in the future. There are a few things which should make that possible. One is that when consolidation happened, the first area that where the consolidation happened was in the corporate sector. So therefore, even while our merger process will be going on, but the corporate sector is one area where that is largely complete. So therefore, the bank is well positioned to capitalize on the opportunities that might be there in that particular sector. The second part is that the overall macroeconomy, the circumstances also, I believe, give rise to certain opportunities. Now, one of course is the fact that some banks, and possibly very rightly from their own perspective, have decided that they will de-emphasize corporate loan growth. Now that of course leaves room for other players which want to grow, and BOB certainly wants to grow faster, and also along with growing faster to have a little more pricing power than was available to banks in the past. The second area again, which again should work out well, is in terms of the bank's inclination to partner with NBFCs. So the NBFCs were providing a large part of the credit to the economy. There are challenges in that sector, and I think the answer to those challenges is that banks and NBFCs must work together. We must recognize the competencies that NBFCs bring. They bring competencies in terms of last mile, in terms of underwriting, which is largely automated, in terms of loan monitoring, in terms of collection mechanisms. But there are challenges that they have in terms of funding that growth on their own balance sheet. So I think the time is just right for banks and NBFCs to work together to make sure that in terms of credit growth, we don't lose the momentum. The economy gets the credit which it requires, and a large proportion of the growth actually gets reflected on the bank's balance sheets.
You mentioned pool purchases came off during the quarter. Now, going ahead, what is your view? Because now there has been this trend of pool purchases not happening for n number of reasons. You know, there is a clear confidence deficit as far as the NBFC sector is concerned. There is also the issue of whether these assets are actually worth what they are being pitched for. What is your view as far as pool purchases are concerned? Is this something that the bank is constantly going to do in the times to come?
Yeah. So I think you are absolutely right. There are some issues which are there in pool purchases, but I'm confident that over the next few weeks, not months, over the next few weeks, they should be addressed, and therefore whatever ambiguity is there, that should get removed. And pool purchases necessarily have to be part of both the strategy for NBFCs, which need to generate the liquidity which is required, as also banks, which need to get exposures in areas where they find some challenge in terms of underwriting directly. Having said that, I believe that the strategy of banks and the engagement with NBFCs should not be confined to pool purchases. That can be one avenue where the two entities can work together, but working together with NBFCs has to be much more organic, where your systems mesh together, whether that is by way of co-origination or simply again where NBFCs become the engines for partial underwriting, for monitoring, for collection, while the assets ultimately end up on the books of the banks.
Fair enough. As far as your approach toward the the entire merger process, which has been going on since April, we understand it's not fully completed yet. There's some ground level issues that are still pending to be merged. How soon do you think the bank will be able to get over that? Because obviously that will also help in pushing, let's say, credit, mobilizing deposits, etc.
So I think when we look at the merger process, we have to see it again that what is the objective that you are trying to meet. So the objective, of course, is to complete the merger process, but also the objective along with that was it should be in as non-disruptive manner as possible. So therefore, even when it was planned consciously, a choice was made that one, we would do it over a period of time. Two, make sure that there is no inconvenience to customers. Three, sequenced in a manner where the most important parts get sequenced first. So therefore, as I mentioned, the corporate book is now entirely on a single platform. When it comes to the retail book, that is something which will happen over the next few months. So even when the merger process was envisaged, it was something which was over a 12 to 18 month period. And my understanding is that the process is moving largely as per plan.
Fair enough. As far as compliance is concerned with respect to banks and the system that we are operating in right now, there is a very clear direction to banks that whenever you have a large NPA, let's say 50 crore and above, you have to conduct a forensic audit. Does this become, I mean, compliance is one part, but does this become a little cumbersome because there's a huge amount of loans that are there in the 50 crore plus category? Does that become an impediment rather than cautiousness?
So I think the fact is that there are always particular junctures in the environment where certain solutions, even if they would seem to be a little bit tough, nevertheless are required. I think as banks, we need to recognize that there were certain issues which were there in the economy, in the way, again, loans were underwritten. So therefore, if you need to, again, make sure that you have a fresh start, you need to recognize the issues and you need to resolve the issues. So, and again, as an entity which is regulated by the regulators, I always believe that it is your job to make sure that you adhere to the regulation, both in letter as well as in spirit, and make sure again that having done that, then you move ahead and do business. Okay,
fair enough. Coming back to the point about retail, now you mentioned that unsecured is a category that you will look at for growth. A lot of your private sector peers had started that a few months ago. Now they are turning a little more cautious. They're saying that there is stress and that is sort of coming out not just in the retail but also in the SME side of the story. There again, unsecured credit is coming into some trouble. How does the bank intend to sail through these issues, and what is the level of concern that you will look at whenever you're trying to underwrite a loan?
So I think in terms of retail loans, it has to be a mix of both secured as well as unsecured, depending upon the tenor of the loan, who you are lending to. So I think in the case of Bank of Baroda, when we talk about the growth of unsecured loans, 29% growth, it is entirely to people who have had accounts with the bank for a long period of time. So therefore, I would believe that as compared to, you might say, some other entities where a similar record of transactions is not there, we would be better placed. And till date, I don't think in that particular segment we have seen any signs of enhanced stress, because it is essentially a book which is fairly conservative. So going ahead also, we need to make sure that it is a mix of secured and unsecured. The relative mix can always get altered slightly over a period of time, but I believe there's scope and there's space for both categories.
Okay. It's just that the fear with respect to unsecured is that in the current macroeconomic environment, if companies are struggling, eventually their employees will start to struggle to be able to pay back their loans, and that may turn up in the unsecured book first and then probably in the secured book later. Is that something that concerns you at all?
So I think banks always must have risk management process in place, early warning signals, and they must again trim their sails given what the environment is. But again, without in the first instance underplaying the risk which was there, or again at the end of it overplaying the risk that might actually be there on the ground.
Sure. Do you feel that there is an excessive level of risk averseness?
I would not say so. It really depends upon the nature of the portfolio. Since the bank is largely, almost entirely, doing its unsecured loans to clients which may have been there with the bank for years and decades, I think in terms of order of magnitude, that the risk that the bank underwrites is of a lower order.
No, not just for Bank of Baroda. I'm talking about the stress of the system, because you have to function with the system.
So I think each institution needs to have its own assessment of risk and must work accordingly. I can only speak for the BOB.
Okay, fair enough, sir. Just the last couple of questions. As far as the growth in the coming year is concerned, now there is a widely held belief that a lot of the corporate sector stress is probably recognized and that part is over. But there is still this entire pool of assets which were to be restructured under the ICA framework, the June 7th circular, which does not seem to have gone anywhere. Do you think that may then prolong the stress?
So I think if we were to take a perspective going back over 2 to 3 years, I think there are a lot of developments which have happened over the last 6 months, 12 months, where we should be fairly sanguine that the resolution process is going to be more accelerated as what it was in the past. Whenever there are new processes which come in, new ground rules which are laid, there will be a period of iteration and reiteration. So to that extent, I think we must have the patience, and also we must have the commitment to see through those processes. Speaking for BOB, as you would have seen, the watch list for BOB has come down from about 14,500 crores to a little over 10,000 crores. So I would believe that while there would be some accounts where the resolution process may get a little extended, but overall, I think we should be seeing lower level of slippages and also earlier resolution as compared to what we have seen over the last 2 to 3 years.
Your coming into the bank from the other side of the aisle after looking at a lot of the restructuring work from the ground. Do you think that IBC is going to lead that charge as far as the restructuring is concerned, or do you think that banks are a better place to sort of resolve it outside and not depend on judicial timelines?
So I think IBC is an enabling mechanism which was essential to first make cases which are referred to IBC's work, but equally again, even to make cases which are not an IBC work, you required the IBC. So I think to that extent it has been a very salutary change. Also in terms of the quality of the law that has come in, I think it is pretty much at par with the most advanced economies. And I do believe that as we iron out the few issues that remain, we should have a resolution process which ranks with the best which is there.
Fair enough. Last question, as far as your focus in the next coming 3 years is concerned, what would you look at? Are you going to look at, let's say, growth to ensure that the bank's balance sheet now grows further faster, because you've seen that stress from the delays because of the merger coming in, but now that you're past it, you probably want to accelerate that growth? Or would you say that let's wait and watch, let's hope that the economy turns around and then push growth?
So I think there are a lot of opportunities which are there for growth. As I mentioned, there are broader circumstances in terms of the competitive landscape being changed, in terms of possibility of partnering with other institutions where the growth possibilities are much stronger as compared to what they have been in the past. So even if overall the economic growth rates are lower than what they were 3 or 4 years back, for a bank like Bank of Baroda, I believe the opportunities are much larger. So I do look forward to faster growth over the next few years.
All right. Thank you so much, Mr. Chadha, for joining us on this
Thank you very much.
Thank you for watching.